Over the last 6 months, one of the big moves has been the US dollar, which has strengthened 7 to 8% against other major global currencies. The reasons for this move have been, number one, fairly strong US economic growth, number two, high and stubborn US inflation, and these two factors mean that market expectations of a cut in US interest rates have had to be put back. Now, when we look at the euro-dollar FX rate, it's headed down to around 103.20 now. One of the negatives on the euro side has been fairly soft eurozone economic growth and a fair bit of pessimism around growth prospects for the year ahead. But something has changed. In the last 4 to 5 weeks, we've actually seen the US economic data soften a bit, and we've seen eurozone data pick up. These two factors together mean that our macro factor model for the euro-dollar FX rate is showing a fair value that has moved up to around 106.50. Now, our analysis and approach is entirely data-driven. We take all sorts of data, process it through a machine learning approach, and that gives us a fair value of a particular currency. What you can see on screen now is a white line that shows you the actual euro-dollar FX rate and a blue line that shows you the macro warranted fair value or model value. And you can see that the blue line has moved higher up to 106. So given all the information, what we see is that the euro-dollar FX rate has significant upside over the next few weeks.